This single AI deal could create a new wave of millionaires, decide the winners of the AI race, and most people have no idea it just happened. Meta has just committed up to $27 billion to buy raw AI computing power from a little-known cloud company called Nebius. And this one move could reshape everything from AI stocks to your next side hustle. Let me break it all down for you right now. Meta, the company behind Facebook, Instagram, WhatsApp, and the whole metaverse dream, has signed a 5-year agreement to spend as much as $27 billion on artificial intelligence infrastructure from Nebius Group. We are talking about rented supercomputers, giant data centers packed with next-generation NVIDIA chips, optimized networking and storage, all dedicated to running massive artificial intelligence models. Here is the breakdown. Around $12 billion is locked in as dedicated AI capacity that Nebius will deliver to Meta starting in early 2027. On top of that, Meta has the option to buy up to $15 billion more of extra compute capacity that Nebius is building for other customers. If third parties do not use it, Meta can scoop it up. So at full size, this deal is worth roughly $27 billion over 5 years. That makes it one of the largest single AI infrastructure commitments any tech company has ever signed. Nebius itself is not a household name yet. It is a European-based so-called neocloud provider, focused almost entirely on high-end AI workloads. The key to this story is that Nebius is a strategic partner of NVIDIA, and the infrastructure Meta is reserving is built on NVIDIA's brand new Rubin platform and the Vera Rubin rack scale systems. Think of Vera Rubin racks as AI factories. Each rack can hold dozens of the latest GPUs plus dedicated AI CPUs, ultra-fast networking and specialized storage, all tuned for machine learning. NVIDIA claims Rubin can cut the cost of generating AI tokens by close to an order of magnitude compared with its previous Blackwell platform, and can train certain mixture of experts models with around 4 times fewer GPUs. Meta is basically saying, we want a front row seat to that hardware. We want guaranteed access to the best possible artificial intelligence infrastructure so we can keep up with OpenAI, Google, Anthropic, and everyone else. Timing-wise, this announcement hit on March 16, 2026, and it comes just weeks after a bombshell analysis from Bridgewater Associates that says the 4 US giants, Alphabet, Amazon, Meta, and Microsoft, are on track to spend around $650 billion on AI infrastructure this year alone. That is up massively from last year. So this $27 billion AI update from Meta is not a random one-off. It is a very loud signal in a much bigger arms race. Now let us go deeper, because the headline is flashy, but the mechanics are where the real money and the real risks live. Why does this actually matter? First, compute is the new oil for artificial intelligence. If you want to run frontier models, train your own large language models, or power billions of daily AI queries across apps like Instagram and WhatsApp, you need 3 things. You need high-end GPUs and AI-specific chips. You need data centers that can power and cool them. And you need fast networking and storage to move data around without bottlenecks. Most people focus on the models: ChatGPT, Claude, Gemini, Llama. But the real choke point is compute. There are only so many cutting-edge chips, and the companies that lock in supply get to move faster, build better AI tools, and undercut competitors on price. This Meta and Nebius deal is essentially a compute pre-order. Meta is saying, instead of trying to build every single data center ourselves, we are going to lock in a specialist partner who is all in on NVIDIA Rubin hardware. Nebius gets the demand visibility they need to build huge AI factories. Meta gets capacity and pricing certainty in a world where AI chips are often sold out. Second, this deal rides on a very specific technical bet, and it is worth understanding at a high level. The NVIDIA Rubin platform is designed for what many people call agentic AI, systems that can reason over long sequences of steps, remember context across many interactions, and coordinate other tools and services on your behalf. Compared to previous generations, Rubin focuses on 3 things: much cheaper inference, meaning the cost per generated token drops, far more efficient training for giant mixture of experts models, and tight integration between CPU, GPU, networking, and storage, so the whole system behaves like a single AI supercomputer. In simple language, Rubin is about running smarter models more cheaply, and running more of them at the same time. For Meta, that could mean better recommendation engines for ads and content, more powerful generative tools in apps, and the ability to serve Llama models as a cloud service at lower cost. Third, look at how this fits into the competitive landscape. Google is pushing its Gemini models on its own TPU-based infrastructure. Microsoft is tied closely to OpenAI and Azure. Amazon is promoting its own Trainium and Inferentia chips in AWS while still buying a ton of NVIDIA. Meta does some of its own infrastructure, but with Nebius, it is outsourcing part of the heavy lifting to a specialist AI cloud while still anchoring everything on NVIDIA's most advanced platform. So Meta gets flexibility and speed without having to build every megawatt of data center power itself. You can think of Nebius as a kind of wholesale club for AI compute. They sign huge long-term deals with hyperscalers and big labs, build these monstrous Rubin-based AI factories, then slice the capacity between anchor tenants like Meta and other enterprise customers. So from a technical and strategic angle, this $27 billion commitment is Meta buying optionality. It guarantees access to world-class machine learning infrastructure without locking them into a single internal architecture forever. Now you might be wondering, is this actually rational, or is this how bubbles are born? Let us talk business and money, because this is where it gets really interesting for investors and for anyone thinking about how to make money with AI long term. On the Meta side, spending up to $27 billion on external AI infrastructure over 5 years is a massive capital commitment. This comes on top of the billions they are already pouring into in-house data centers, custom chips, and research. Short term, that kind of spend can pressure free cash flow and scare some investors. You might see headlines about rising capex, lower buybacks, maybe even workforce cuts in other parts of the business to fund the AI push. But here's the flip side. Meta's core business is still ads. If AI infrastructure lets them target ads more precisely, rank content better, and roll out powerful artificial intelligence features across Facebook, Instagram, WhatsApp, and their AI assistant, the revenue leverage is enormous. Imagine you improve ad relevance by a few percentage points across billions of impressions, or you launch new AI business tools like smart assistants for small advertisers, AI-generated creative, automated media buying, all powered by Meta's own models. That $27 billion starts to look like a growth engine, not just a cost. For Nebius, this deal is transformational. They are no longer just a niche AI cloud player. With this agreement plus earlier multi-billion contracts, their forward revenue visibility explodes. That tends to drive higher valuations, cheaper financing for new data centers, and a stronger seat at the table alongside the big US hyperscalers. If you are looking at AI stocks, Nebius goes from interesting to core pick and shovel play. They do not have to win the consumer AI app war. They just have to keep selling shovels, in this case, access to high-end NVIDIA Rubin compute. Speaking of shovels, NVIDIA quietly wins again. Rubin and Vera Rubin racks are the foundation of this entire story. Every dollar that flows from Meta to Nebius ultimately flows through to NVIDIA hardware and software. That is why so many AI investors frame NVIDIA as the core way to play the entire artificial intelligence ecosystem, from ChatGPT to Llama to whatever comes next. Zooming out, this deal is a perfect example of the $650 billion AI capex wave Bridgewater is warning about. 4 companies, Alphabet, Amazon, Meta, and Microsoft, are now responsible for a huge share of total US capital investment, and most of that growth is data centers and AI automation. If the AI boom delivers lasting productivity gains, these investments could look genius in hindsight. If not, you get overcapacity, margin pressure, and some very unhappy shareholders. So what does this create in terms of opportunities and risks for you? On the upside, there are at least 3 types of plays. First, direct AI stocks, names like NVIDIA, Meta, and specialized AI infrastructure providers. These are volatile, but the fundamental story is clear. Intelligence scales with compute, and compute is being built out at unprecedented speed. Second, picks and shovels around the edges, data center real estate, power utilities that feed these AI factories, advanced cooling and networking vendors, even companies providing fiber optics and glass for AI data traffic. They are not branded as artificial intelligence companies, but they profit every time someone builds another Rubin-based cluster. Third, the application layer. As this kind of infrastructure comes online, the cost of running powerful models drops. That makes it more viable for you to build an AI business, launch an AI side hustle, or offer AI tools to clients without needing your own data center. Of course, there are losers too. Legacy IT infrastructure vendors that do not adapt to AI native architectures could see declining demand. Companies that rely on cheap human labor for repetitive knowledge work will face pressure as AI automation gets cheaper and more capable. Certain mid-level office roles, especially in routine analysis and reporting, are clearly at risk. At the same time, new AI jobs are popping up. AI operations engineers, data center reliability roles, prompt engineers, AI product managers, model evaluators, and compliance specialists to make sure AI decisions can be explained to regulators. These are not science fiction. They are already on job boards. But let us pull this down from Wall Street and hyperscale clouds to your daily life. What does this sort of $27 billion AI infrastructure deal mean for a regular person in the US? First, it means better and cheaper AI tools over the next few years. When the cost of running powerful models drops, you can use more artificial intelligence in more parts of your life without paying enterprise prices. Think about 3 practical use cases. In healthcare, imagine your local clinic using AI to summarize your medical history, flag potential issues, and draft documentation in seconds, instead of doctors spending half the appointment staring at a screen. The heavy lifting runs in these AI factories. You just experience a visit that feels more human, with your doctor actually looking at you. In education, picture an AI tutor that lives inside WhatsApp or Messenger. It understands your learning style, speaks in your language, and can walk you through math, coding, or exam prep using examples from your own interests. Students get personalized attention that would otherwise be impossible, especially in under-resourced schools. For freelancers and small businesses, this is where the money angle gets real. A 28-year-old freelance marketer in Atlanta can plug into the best AI tools 2026 has to offer, from video generation to copywriting to analytics, all powered by models running on infrastructure like Nebius and Rubin. Suddenly, one person can offer a level of service that used to require a 5-person agency. That is leverage. Now I am curious, do you think this level of AI spending is a smart long-term bet or an insane bubble waiting to pop? Drop your take in the comments. I actually read every single one. And if you are finding this breakdown valuable, you know what to do. That subscribe button is right there, and it genuinely helps this channel, SKM AI Expert, keep bringing you deep dive AI updates for free. Let us talk about where this is heading next. Over the next 6 months, expect more announcements like this. Long-term, multi-billion-dollar AI infrastructure agreements between big tech and specialist cloud providers will become normal. Everyone is racing to secure GPU capacity, especially for agentic AI and large-scale inference. Within about a year, as Rubin-based systems come online across Nebius, Microsoft, Amazon, and others, we should see a noticeable drop in the cost to run high-end models. That opens the door to more real-time AI in consumer apps. Think live AI copilots in video, smarter customer service bots that actually solve your issue, and more capable AI business assistants hooked deeply into your data. 5 years out, the story shifts from pure build-out to optimization. The companies that locked in the right infrastructure now will have a moat. They will be able to deliver advanced AI at scale, while latecomers struggle with higher costs and weaker performance. At the same time, governments and regulators will be laser-focused on energy use, explainability, and safety, especially for AI that makes consequential decisions. So what should you do right now to stay ahead of this wave? First, level up your AI literacy. Do not just use ChatGPT or some random chatbot. Learn the basics of how large language models, GPUs, and AI infrastructure work at a high level. When you hear about Rubin, Vera, or trillion token context windows, you should at least know roughly what that implies. Second, align your skills or your business with the direction of travel. If you are in a job that can be automated by AI, start shifting towards roles where you manage, integrate, or supervise AI systems instead of competing with them. If you run a business, audit your workflows and ask, where could we use AI tools to reduce costs or open new revenue streams as compute gets cheaper? Third, if you are an investor, treat AI investing like any other high-growth theme. Diversify across the stack, from core AI stocks like chipmakers and hyperscalers to the second-order plays in data centers and energy. And always remember, none of this is financial advice. Do your own research and match your risk to your time horizon. Here is the big idea I want to leave you with. Models get the headlines, but infrastructure makes the money. The companies that control the factories of intelligence, these Rubin-powered AI super data centers, are quietly shaping the future of AI business, AI jobs, and even the future of AI regulation. Today's $27 billion Meta and Nebius pact is one snapshot of that. Tomorrow, it will be another hyperscaler, another AI chip, another wave of capital. The only real question is whether you are just reading the tech news or actually positioning yourself to benefit from this shift. If you like staying ahead of moves like this, hit subscribe and stick with SKM AI Expert. Because in the new AI economy, information compounds, and the people who understand where the infrastructure money is flowing will have a very real edge. Alright, that is it for this AI update. I am Kashi, this is SKM AI Expert, and I will see you in the next breakdown.